No, there's so much to digest today alone, right? The market started off in a bad mood because of the ECB, hawkish commentary. The Atlanta Fed GDP number for second quarter is now at 0.9. That was at 2.1 just a month ago. And then, of course, the CPI tomorrow. And I know that the CPI number is important, whether it's better or worse. It's going to be high, Scott. It's not going down materially anytime soon. And I do not think that the Fed can actually get the inflation down to a 2 or 3% level anytime soon. And so that's going to be an overhang on the market. If you look at the components of CPI, it's really important to see. Energy is 8.3% of CPI, and energy is now at levels we've not seen since 2008. China is also reopening, and so you're going to see better demand. Shelter is 32.5% of CPI. We know home prices are high; they're going to stay elevated, and rents follow home prices. And then, of course, medical, 8.4% of CPI. The Fed can't do anything about any of these things, in my opinion, without really causing a massive recession. So I still say 50-50-50. Is what they're going to have to do. We now have to watch the ECB, and they're behind the curve. And so there's a lot to grapple with at this point. No wonder why the market has been in this sloppy trading ranges and the multiples have contracted.
Now I feel like, Steph, you're incrementally more negative than you've been, because this sounds a little bit different and maybe somewhat nuanced to the Stephanie Link who I've been speaking to of late.
Yeah, no, there's no question about it. I mean, it's hard not to be a little bit more negative. Now, look, the market is down a lot, and I'm appreciative of that. I'm respectful of that. I am selling some stuff, and I'm still buying some stuff. So I'm just trying to stay balanced. I have much more cash than I have because I just don't see the catalyst to get us going higher anytime soon with all of these uncertainties in the way. Do I think that there's another 10-15% downside from here? I don't really know, Scott. I mean, 15 times is the long-term average multiple for the S&P 500. We're at a little under 17 times forward. So could we go down? Certainly. Could we bounce higher? Yes. But we have to get a little bit more certainty in the equation. And until we do, you're going to see a trading range.
Going to be interesting if tomorrow is a positive number, perceived to be positive, and then there's a Victoria sell on the news event because the market just doesn't feel so good, and you don't think the bottom's in.
No, I don't. I think this was more of a dead cat or bear bounce that we've seen here. It's been nice to get some stability in the back end of May. I know we're all holding our breath tomorrow, but I think any human that lived, eat, breathe, filled up with gas, or shopped at a grocery store during May is going to think the CPI is going to be at least 0.8% higher and at least 8.3. I don't see, I mean, maybe did we have peak in March? Possibly, but peak and plateau. I don't think that's going down anywhere soon. And even if we get it down a little bit, I think you're leaving this year at a 6 handle, not a 2 handle. The only way the Fed gets this under control is to go to a recession. That's the only way we've seen a commodity spike end. I always say the 4 most dangerous words to investors is this time it's different. It's never different. We've been in this market before, and it doesn't end well. And I would ask you, name one time the Fed has actually navigated this type of market correctly. And I know we're saying small L recession, big R recession, you can go West Wing and call it a bagel. Doesn't matter, it's going to happen.
You asking me or you asking Adam Parker to my left? Because he's the one trying to make an argument that things aren't as bad as everybody suggests that they are.
Well, I think there's a big difference between the S&P 500 earnings and the GDP. I think the Fed's executed this 3 out of the 12 times in the last half century, so the odds are certainly skewed against them doing it well. Part of what my logic has been, and some people disagree and some people don't, but I think it's a healthy debate, is will the Fed recognize exactly Stephanie's point, that they can't really control, cutting rising prices in certain areas, wheat, semiconductors, and other things born out of the shortages from the COVID. And if they realize that, maybe they tread a little bit less aggressively on the hiking path.
What, are they just going to give up?
Well, I think they don't have to do 50 every meeting. I think there's a happy medium between giving up and doing 50 every meeting, letting it be data dependent, treading. I mean, I'm not saying these guys are money and they're going to nail it. I just think if they end up raising a ton this year, causing recession and cutting in Q4 2023, that, it'll be a field day of incompetence that we'll be talking about at the, when you and I are down here at the end of 23. So I think they're better off moving a little bit more slowly than the most hawkish people currently believe. And I think generally they're pretty smart people with good access to information, and they'll ultimately get there. But we'll see.